So here's what I think is going to happen. Let's predict the future. I fully expect central banks like China, Russia, and whatever else are going to keep buying gold. And at some point, we're going to get in ETF inflows to switch from outflows to inflows. What's that going to take? I think is the U.S. stock market to stop going down, stop going up, meaning that it's significant competition. And right now we still have T-bills at 5%. That's significant competition for anybody, in the Western world to not be in the U.S. stock market. So at some point when we see that we'll probably have a decline in equities, gold I think is going to take off. And gold is just, to me, it's a matter of time it gets to 3,000. I just don't know when. And this is how it does it historically.
Gold has surged roughly 5.6% in the past month and 16% in the past year. Gold demand has remained solid through the end of last year as central banks continued buying it up as an inflation hedge. Senior commodity strategist of Bloomberg Intelligence, MikeMcglone, expects ongoing growth in the price of gold, potentially reaching $3,000 per ounce, although the timing of this milestone remains uncertain. He further underscores GLD's 20% outperformance over the S&P 500 ETF since 2021, indicating gold's dominance over stocks. GLD has underperformed the S&P 500 this year, gaining 3.2% versus 6.5% for the S&P through Tuesday, March 5th, but it looks to be catching up in March. Many investors believe gold still has a place in long-term portfolios. Analysts, including MikeMcglone, partially attribute gold resilience to central banks, especially China, which actively acquire gold. Despite ETF outflows, gold persists in its upward trajectory, signaling a distinctive strength. According to a survey by the WCG, 24% of all central banks are planning to build up their gold reserves in 2024, on concerns about the USD as a reserve asset. The People's Bank of China has been announcing a non-stop gold reserve since November 2022. And during these 15 months, the PBOC's reported gold purchases piled up to 297 tons. Additionally, Mike acknowledges the global market's dependence on the stock market's performance and voiced uncertainty regarding the Fed's decisions. While anticipating a shift in the flow of ETF investments, he foresees a transition to inflows as momentum in the stock market begins to decelerate. Now, we present the clips of MikeMcGlone's insights from his recent interview with David Lin. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The top gold ETF versus the total return of SPY, the top S&P 500 ETF is about 20% since the end of 2021, which, right before the Fed started tightening. And S&P 500 is about 14% or so. So gold's actually beating. Now I actually picked a price in time, but a significant price in time. And that to me is the risk, that gold, this silly rock that you take out of the ground and put back in the ground, is beating the performance of the stock market. To me, that's the big risk. In a normal recession in the US, that should happen. The difference is also gold is only like $50 from the high above the high it made in 2020. It's just kind of hovering here, versus most other markets are well above their old highs. Certainly the S&P 500. So just a little reversion. The S&P 500 typically pressures all assets, but I think it's going to be different from when it did that to gold in 2008. It dropped 30% and then went back up because gold's just waiting to go higher. And here's the key thing I like to point out is what I'm about gold is that world order shifted with the unlimited friendship, and we all know the biggest, deepest pockets on the planet, central banks are buying gold. China's the number one suspect, and not just China's central bank, but Chinese citizens. And despite, I would say, almost unprecedented ETF outflows in the US, in most ETFs, global ETFs, gold's still ticking higher. That's showing divergent strength. So here's what I think is going to happen. Let's predict the future. I fully expect central banks like China, Russia, and whatever else are going to keep buying gold. And at some point, we're going to get in ETF inflows to switch from outflows to inflows. What's that going to take? I think is the U.S. stock market to stop going up, meaning that it's significant competition. And right now we still have T-bills at 5%. That's significant competition for anybody, in the Western world to not be in the U.S. stock market. So at some point when we see that we'll probably have a decline in equities, gold I think is going to take off. And gold is just, to me, it's a matter of time it gets to 3,000. I just don't know when. And this is how it does it historically. And I think the market's not so much looking for a recession as far as pricing, it's just expecting normalization. And here's my key issue is we've been basically straight up in the stock market since it bottomed in October, up over 20% without a correction. I mean, we had 1 week was down 1.5%. That was the first week of the year. Bitcoin's had a correction, gold's had a correction. You need those corrections to flush out those speculative week longs and go back up. It's worked good for Bitcoin, it's worked good for gold. Stock market hasn't done the S&P 500 doesn't. To me, that's the biggest risk. And then we also have some gaps below the market in some things like S&P mini futures. But the fact and the macro is, to tilt over to the biggest macro, we can go wherever you want, is this to me is the micro of the US stock market fitting into the macro of the whole world. Everything is completely reliant on that US stock market to keep going up. So that's why I'm looking at, for just give me one little correction and see how things react. 10%, that October correction was 10%. It put in a good low in copper, put in a good low in Bitcoin. It kind of helped spur the gold to keep rallying. That's what we have to get past. So right now, I think this is a silly stage, and the market's just finding out that every day the stock market goes up, Fed rate hike expectations go down. I don't know what Chairman Powell's going to say, but I hope he helps solidify that. I think his risk is he doesn't want to create volatility, but he's also creating a little bit too much speculative excess by pointing out they're going to be easing anytime soon.
During the interview, MikeMcglone expressed concern about central banks' excessive liquidity creation and inflationary risks. He stressed the need for careful liquidity management to prevent economic imbalances. Liquidity in the foreign exchange market is increasing due to a rise in the inflow of U.S. dollars, riding on growing remittance, export earnings, and currency swap deals. Increasing excess liquidity in the U.S. banking sector since early 2023 has ensured an extra dollar is always waiting to be invested in the latest hype. Pointing to unprecedented liquidity injections and fiscal stimulus, MikeMcglone dedicates the rising gold price to this backdrop. Let's get back to the interview.
Selling of assets is an unwind. Purchasing of assets, I hope they stop doing that. And I think in the future might realize that the excesses of liquidity that we created, we've reached the limits of learning the human lesson nature of creating too much liquidity and inflation. That to me will be the lesson to the peak of 2022. Hopefully it'll resonate forever. But forever doesn't last too long sometimes with politics. But that's what I think is we're just reducing that right now with quantitative tightening. To go back to quantitative easing, we'll need something pretty serious. And I think the next time we go to a recession, and I won't say if, I hope they just lower rates and keep them low rather than adding too much liquidity too fast. It's this impatience of human nature that we want to get past. I just wrote about that recently at the beginning or at the end of last year. For the end of this year, the Fed Fund futures a year ahead had priced up for 100 basis points of easing. I always look at that 1 year ahead. Right now, it's about 100 basis points of easing. And I just look at it every day that stock market goes up, those easings that market expects are trickling down. So maybe what's happening now is that high price cure that affected commodities starting about two years ago is trickling into the stock market. Every time it goes up, the liquidity pump that expecting goes down. And I think that's the risk we face. It's kind of the potential losing game. And I think the back from the future look will be this is kind of silly stage. And markets are plenty of those irrational stages. But the bottom line, I think, from a U.S. standpoint, is the exceptionalism of the U.S. is quite extreme, which is wonderful. That's part of the reason it's hard to be bearish the dollar, but it's the background of I would say the repercussions of the biggest liquidity pump in history, the biggest amount of fiscal stimulus ever without a recession or a war, and the wealth effect from those key things that are still holding up markets. And then there's the human nature that I think I'm really worried about, where you get to these levels, it always makes highs where you have to perform with the market. If you don't, you're fired. And I think we're at that stage now. That's where I just look at this. Bottom line for me is that U.S. stock market's wonderful if you can find other ways. I think what's happening with most smart money now is they're using option strategies to be part of that upside gamma and not have the risk and the downside, which is, I used to do that for a living, structure that for myself and for clients.
According to the World Gold Council, gold is often correlated with the stock market during risk-on periods and decouples and becomes inversely correlated during periods of stress. This is unique amongst most hedges in the marketplace, it said on the WGC website. Gold price trends have generally been bullish in the long term, but there has been more or less consolidation in the last couple of years. With so many negative factors simultaneously, it's difficult to imagine that gold won't continue to strengthen over the next decade. Given the recent trends in the global market, what factors do you think will have the most significant impact on the future price of gold? Drop your thoughts in the comment section below. If you find this video informative, Don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.